Welcome to our High Rock monthly video for March. I'm Scott Tomlinson, and with me on the call today is Paul Tepsich, our portfolio manager and founder. High Rock was founded back in 2010. We started our private client wealth management division in 2015. If you are interested in learning more about us, visit our website at www.highrockcapital.ca. Well, it's spring, and March was a very nice month for all financial markets pretty well. Gold, Paul, up 9% over the course of the month and still on fire into April.
Yeah, hitting new highs last month and starting again this month, as you said, Scott. And we were talking earlier, I guess some of the driver in the price of gold and silver has been a more dovish U.S. Federal Reserve and perhaps the ECB, Bank of Canada, et cetera, all these Western banks, central banks. But also, I think there's been central bank buying over the last number of months. It's been driving it higher as well. And that's probably on the back of these Western democracies running these massive deficits and obviously destroying the purchasing value of their local currencies.
Right. Well, that makes sense. On a year-to-date basis for the first quarter of 2024, best performing asset classes have been basically U.S. equities and Canadian preferred shares, with gold not so far behind. So I'll let you comment on preferred shares a little later when we talk about the special mandates.
Okay.
I would imagine that the laggards are a function of still no movement in central bank monetary policies, although it is expected to come maybe as soon as June at with the U.S. Federal Reserve and the Bank of Canada. But I guess that remains to be seen.
Yeah, and I think I read this morning, I can't remember who it was, Scott, it might have been Goldman Sachs, looking for no rate cuts out of the U.S. Federal Reserve over 2024. So that the past week or so, there's been some Fed speakers and I think some strategists, analysts, et cetera, that have tempered their rate cut views a fair bit. So we'll see. I think you're right. And until they actually do something, it's going to be tough to make a call.
Yeah, I hear you on that. As it is quarter end, we just bring our clients' attention to what we would consider to be a good comparison against your portfolios. When you're looking at the performance of your portfolios, we look at Morningstar, who is basically the mutual fund ETF guru service, which follows many things, but from a balanced perspective, they have an average of over 1,400 mutual funds, and reflected in these numbers here, the trailing returns, the year to date, 1 year, 3 year, 5 year, and then full year returns for 21, 22, and 23. Again, bringing your attention to 2022 and how it has certainly impacted the longer term averages. And of course, we're always focused on the long term here at High Rock. So that's why we put those up. But you can look at your portfolio, compare, and if you have any questions, we're certainly here to address them. Paul, talk about our special mandates.
Yeah, I guess the highlight certainly has been the preferred share mandate. We started basically in mid-November or so, and we had pretty good take up from existing clients adding to that mandate. That has gone extremely well, and I'll talk about it again in our fixed income update, fixed income model update. But we have that mandate is fully invested and been that way for a few weeks. We've taken advantage of some work we've done in the bank capital side of things, and we have about 30% of that portfolio in bank-related or bank preferreds, excuse me, which we believe will be redeemed at their next redemption dates, which for us, we're playing out to, the third one is out to January 2025. We got one in July, one in November, and one in January 2025. So that's really been a lot of the impetus for the performance that we've seen both year to date and since inception, mid-November or so. The other special mandate we have, high yield, has been a little less robust on the return side, quite frankly, because the last 3 years or so, we've had phenomenal returns in the high yield market and in our mandate, without going into detail, but we've had a very large weight in the fossil fuel energy sector, and that's performed extremely well. And so well, in fact, it's created a high class problem where these bonds are now either at par, and quite a few of them have been called from us before the maturity date, which high yield bond issuers are typically allowed to do. And quite frankly, we've got more that will be called. So this is going to be what I would call more of a coupon year in the high yield space, which is nothing to sneeze at when we're looking at, 5, 6, 7% cash yields in that portfolio. So that kind of wraps up the special mandates.
Yeah, and I just like to also focus on the longer term returns from that particular mandate, the high yield mandate, because if you look back over the course of 3 years, again, through that really bad year in 2022 for financial markets, the outperformance of the high yield mandate through that period is reflected in those longer term averages. So you may not get the 1 year average return or the 1 year return looking as sweet perhaps as it has in the past, but over that longer term period, 3 and 5 years, that's going to hold up really well.
Yeah, it's, again, without giving the performance numbers away, it's been a great run with, good, excellent risk adjusted returns. Let's leave it at that. We're very happy with it, as our investors in that high yield mandate are as well.
Correct. Okay. And moving on, obviously we're always worried and concerned about everybody's goals and if they're changing, and we want to make sure that we're on top of that. So as always, we're available to talk about wealth forecasts and the longer term aspects of wealth management. So please never hesitate to get in touch if you have any questions, concerns, or updates for us. Let's talk a bit about the global equity strategy. As we saw before, equities have certainly been performing again this year, led by the S&P 500. NASDAQ is keeping pace as well. Again, we're a little less impressed by this because there's very few participants in this rally. Although I would say through the month of March, some of the mid-sized companies and even international companies are starting to catch up a little bit, and that's the momentum factor. But smaller companies, emerging markets companies, are still lagging, and to us, that's a bit of a sign that perhaps things are getting carried away at the with the major indices, and further to that, the extreme greed level of the CNN Business Fear and Greed Index is highlighting that. And as always, when we see these things happening, what is naturally happening is that it takes our client portfolios to an overweight position in those outperforming asset classes. So we're better sellers of those for rebalancing purposes, and then certainly better buyers with the cash that we are able to redirect to underperforming assets, or in the case of some clients who need cash flow. So that's the current strategy, continuing to rebalance to take profits when we can in the global equity market. Over to you, Paul, for an update on the tactical strategy.
Okay, tactical. We were somewhat active over the course of March. Recall we had a position in Cenovus, large integrated oil sands play in Canada. That was not a core long position. We did have a decent sized weight in it. We sold half and then the other half. So we are out of that position. That worked out pretty well. I think we probably averaged around 20% return. Unfortunately, I didn't know the IDF was going to bomb Damascus, because that has popped oil up further, both Brent and WTI. And along with Cenovus stock. Nonetheless, a nice little position and trade that we had. We sold half of our position, although it was very small to begin with, in Auto Canada. That stock, they reported their earnings, and they were not great, and the stock got hammered from like $23 odd to I think 17-ish, and the same day closed up above 23 and has been on a bit of a tear. And quite frankly, I'm not totally sure why. I've talked to some other guys who own the stock. I've talked to a friend who runs a conglomerate of a ton of auto dealers, like Auto Canada is. And you know, they're doing a deal with Kijiji, but I just don't know. Some analysts put out a note on it, on this deal with Kijiji they're doing, but I think it's a lot of pie in the sky, if you ask me. So we continue to hold half of what we have, but again, it's a super small position at this stage. Another standout I just want to highlight in the tactical model is the Source Energy bonds, which again is a sand fracking business. And we bought these bonds you know, almost 3 years ago in a very distressed position. I think we started buying them down at 25 odd cents, and then maybe up at 52 odd cents. But our adjusted cost base for most people that own them, that were with us about 3 years ago, is probably around 42.5 cents on the dollar. The reason why I'm mentioning that today, not to tout how great a trade it was, but really it's now back to par. The bond is due in March 2025, and we believe, and our position has been through all of this, that the issuer, the company Source Energy, will refinance this bond before maturity with some private credit, which is what they used to get rid of their bank debt. They took down some private credit. In the meantime, we're still collecting daily interest income on this bond. It's 10.5% coupon. It's huge. So even though it's at par, you know, if we can get another 3 to 6 months out of this bond before it is refinanced, that would be quite fine with me. So if you add up the return on that bond, it's, you know, obviously more than double, because we've had it for almost 3 years at 10.5%. Interest income. So it's absolutely huge. And we had a decent sized position in that. So I'm very happy with that one. But one on the downside, Scott, kind of interestingly, is a National Bank analyst, telecom analyst, put out a hold on BCE stock. We do own some BC stock. And I think he's not looking for as much growth. I was reading through his report last night. There's obviously more competition coming into play now with Quebecor Videotron taking some of the wireless from the Shaw Rogers transaction, and you know, they're going to want to pump through some deals. But this stock now is almost at a 9% dividend yield, and if you believe the dividend is safe, and it's at a 10-year low. 10-year low, this stock. So I think it's probably, to be contrarian, probably not a bad time to add to this position. And certainly for some newer clients that are underweight, we'll look at that. Those are about the highlights for the tactical model.
All right, thanks. And that's really interesting about BCE, because it is a fairly blue chip company with a 9% dividend yield. I think that you're right. sounds pretty attractive to me.
Fixed income. First of all, in the high yield slice of the pie, we're forced to, quite frankly, do a trade because we had Cineplex bonds, a 7.5 2026. Again, going back to how high yield issuers can call their bonds before maturity. Cineplex did in fact that. I met with the CEO and CFO back in January at a high yield conference and kind of knew they were going to do this. So they reissued a 7 5/8 2029 bond, which we bought. So we had one called and replaced it with another bond, very similar size coupon. The only other thing to add, again, going back, is the preferred shares. So we had mentioned this, I think last call, but and I certainly mentioned it in the preferred share mandate discussion. So just to be clear, within our fixed income model for all of our balanced clients, we do hold preferred shares. Now, as I think I mentioned on the previous call, we added back in November, those who were with us then, tdbank.pf.b. That preferred share is coming up for redemption in July 2024. The banks in the prospectus on these preferreds, they have to allow minimum 30 days notification as to whether they're going to redeem or leave outstanding and extend them for another 5 years. So we imagine we'll hear, mid-June. So, just another 2 months-ish as to what TD Bank is going to do. TD Bank is in an enviable regulatory capital position in that they're long excess regulatory capital, which these preferred shares are classified as. So they're going to be in a position, we believe, to take those out. So we own those in a good size weight. We also, because I think we're going to be called out of those, we extended out and bought a BMO, and we did this in early March, BMO.PR.W. And we bought those at $20.85, and they're trading up around $23.85 now. So we're up about, the TD Bank one, we're up about 30% plus the dividends that we're going to receive. And the BMO, we're up about 14%. Now that BMO is callable or redeemable on the reset date in November 2024. So again, these are reasonably short-term trades that we believe we're going to have a critical event occurring. I think both those prefs will be called or redeemed from us, and will go up cash. Now I'm contemplating adding another one, which is January 2025, to the position. So we are sitting in an overweight position in our preferred shares within that fixed income model. But again, if we're right, come November 2024, near the end of this year, we're going to drop down pretty substantially right back to the market, or our model weight, if you will. So I feel pretty comfortable with both these positions, and as I said, I might even add a third one. It's super hard to buy, like everybody. The past month, I'm glad we got these BMO.PR.Ws in early March, because all kinds of fast money hedge fund guys hopped on this trade, and we were on this back in November. Just even the bank trade, forget about the rest of the pref trade. And I'll just even extend this one more. I won't go on too much here, Scott, but when all these index funds and ETFs, preferred share ETF funds and ETFs, they have to, once they get these banks, there's going to be billions of dollars worth of bank preferred shares being redeemed over the next year or so. That money is going to have to stay invested in, and the performance has been good. So if retail money advisors chase performance, that money's going to continue to be rolled back into these preferred ETFs, and they're going to be forced to continue to buy ETFs. So all the insurance company prefs, the corporate prefs like BCE, TRAP, Enbridge that we own, they're being bid up now, not as dramatically as the bank prefs, but they're being bid up now as well. And the bank pref trade, it's like really hard to buy blocks. We were buying blocks of 50, 75, 100,000 at a crack, and now it's very difficult. So I'm thankful we did what we did when we did it. That is it, Scott. I ramble.
That's okay. It's a great update. And the one question that I think I throw back at you is, at what point in time do you see the preferred share market getting overvalued to the point where it's maybe looking like we should start maybe paring back?
Well, that's a good question. But we will be naturally pared back by November, by the end of the year, with both the TD being redeemed in July and the BMO being redeemed in November. And then we're back down to our model weight. And in our model, we own one rate reset, BCE.K, and we own two perpetuals that are fixed rate. So if rates, government bond yields drop dramatically, which they could, quite easily, and the economists that we have research for are looking for quite dramatic cuts in the overnight Bank of Canada overnight rate over the next year and a half. Our fixed rate perpetuals will benefit from lower rates. So I quite like how we're positioned here to have some of these bank prefs be called. We're still with a BCE.K, which is a rate reset, which benefits from higher rates, not lower rates, but we own two that are fixed rate, so they'll perform pretty well. And for the preferred share model, preferred share mandate clients, our plan, as we discussed back in November with them, is to gradually move into more fixed rate prefs as well. But they've got over 30% in 3 bank prefs that will be likely gone by January. So they'll be long a pile of cash, and I think we'll probably redeploy that into some fixed rate prefs. Does that make sense?
Yeah, got it. That's great. Great update.
Awesome.
Thank you. And lastly, it is still, we have till the end of April to file your tax returns. And from my discussions with Diane, we're waiting on disposition reports, which we expect to be ready this week. And that's a function of what we call return of capital adjustments to the prices that get adjusted over time on the purchase prices. So anything that's been sold, of course, is going to have a capital gain or capital loss based on that purchase price. And if that purchase price, or that cost base, is readjusted, then we want to make sure we've got it accurate. And that it happens as of March 31st. And then Raymond James produces the disposition reports following that. So again, they should be ready this week. And those who have non-registered accounts can get their gain loss reports organized for their tax filing. All right. It was a bit of a long one, but I think very informative for everybody. Thanks so much for taking the time out of your busy schedules to tune in. We'll be back with the next update at the beginning of May. And just so happens that I'll be looking forward to being in Vancouver in the beginning of May to visit with our Vancouver clients. And that's always a great time for me, a great time of year. Usually the blossoms are in full bloom, so that's it's pretty cool to walk around the seawall and see all of that. Anyway, I'm Scott Tomlinson. On behalf of my colleagues Paul and Dan, we want to wish you the very best for the month of April, and we'll see you again at the beginning of May.